when it comes to investing, people tend to not put all their eggs in one basket. They tend not to invest just in one specific area, because if that one specific area does poorly, right, then everything goes bad, everything goes south. And the larger variety, because of that, people tend to diversify. They tend to invest in a lot of different areas. And those areas, they tend to look at areas that have what are called independent or uncorrelated risks. That's where there's a risk in one area it doesn't affect another. So, for example, where you're going to have uncorrelated risk would be investing in, say, McDonald's and a chain of massage parlors. Affecting one doesn't affect the other. Something that can negatively impact one wouldn't necessarily negatively impact the other. When risks are the same, however, right, they're called correlated risks. So that would be investing in McDonald's and Burger King. And so chances are something that happens that negatively affects McDonald's is also going to negatively affect Burger King. So people tend to diversify, and to be safe, they tend to go in areas that have uncorrelated risks. An example of this is within healthcare is nursing homes versus drug companies. And when you think about which one is riskier investments, which one is more likely to fail, you would think, all right, well, probably drug companies, because drug companies, there's a lot of research and development, and if they don't succeed, then, or if that research doesn't succeed, it's a lot of wasted money, and so a lot might fail. Evidence doesn't support this, however. Drug companies in general seem to be very strong, whereas nursing homes, a lot of them went bankrupt in the 1990s, and the difference comes down to this uncorrelated versus correlated risk. So drug companies, they diversify. Right? They invest in they put research to a lot of different areas. They have a lot of different types of drugs. So if one of those drugs fails, right, then they have another one or more that are allowed to pick up the slack. And so this diversification allows for uncorrelated risks. Nursing homes, on the other hand, have correlated risks. They are basically all run by the same machine, which is Medicaid. And when Medicaid and Medicare were cut in 1997, a lot of nursing homes felt the same problem and shared that risk, and they closed because of that. So when we look at risk in general, there's three types of business risk. The first type of business risk, and a business risk is risk in opening a new business. The first one is revenue. Revenue is the biggest risk out there. Right, you start up a business, are you going to have enough money coming in? Okay. You open a business, there's the chance that people just won't want to come there, and so you could have a lot of issues. You could not have revenue coming in, you could not have business, and so the revenue risk is going to be high in a lot of cases, especially when you talk about restaurants. Right? A lot of restaurants, if it doesn't take on or doesn't take to people, they can not have people coming in. It doesn't have to do with the quality necessarily, with the location. It might just be people just don't go there. So medicine, on the other hand, doesn't have a great revenue risk, because with medicine, it's not driven by preferences or tastes. It's driven by need. And on top of that, people have insurance, and they're always going to have insurance. Now, the uninsurance rate may fluctuate depending on what happens with politics of it, but for the most part, it's not a very risky on the side of revenue. The second type of risk is operating expense risk, and this is risk of whether or not the cost of doing business will change, whether or not your expenses could skyrocket. And where you're going to see this be the biggest is anything with transportation, because with transportation you need fuel, and fuel costs are constantly changing. And so airlines can have pretty high operating expense risk. Medicine, not really. Medicine really doesn't have those same risks either. With medicine, there's not a lot of changes in the cost of materials for the most part. It's usually steady and even. The third type of risk is financial leverage, which is how much leverage you have to take out to get a loan to start your business. Do you have to put up your home or your car or whatever else? And medicine, this is the one case where the medicine is not really that much different than others. But because the revenue and operating expense risks are relatively small, yes, that financial leverage risk is the same, but overall the business risks tend to be lessened. When just one physician is starting a practice, that physician has all the debt and they get all the revenue. Right? So everything is there. And as the business grows, that person has to make decisions of any initial investments, any kind of growth, if the gains will outweigh the costs. Now, as more physicians are hired, or as more physicians start together, those debts, those revenue, it gets spread out between more and more people. And it's really in the structure where it determines, who is responsible for the debt, who's getting the revenue, who's reaping the rewards. And with corporations, for example, if a corporation is formed, the partners are protected. The personal assets are protected. Whereas with partnerships and sole proprietorships, it's not necessarily the case. Now, when it comes to who owns the business and the patients, right, sole proprietorships and partnerships, everything is on the owners. With corporations, however, it's a little bit different because with corporations, the physicians are the ones who are making those decisions, but they're not necessarily the owners. And so there can be a large difference in goals between the owners, who are the shareholders of the company, and the decision makers, right, who are the physicians. And so that's where we get what's called agency. And agency is when one party makes a decision on behalf of another one. And the most common example of this is when you have a store owner and you have the manager of the store, where the manager makes decisions on behalf of the owner, because the owner is the one who's going to be better or worse off because of those decisions. So with hospitals, that can absolutely be an issue when the owners might want to cut costs and maximize revenue, while the doctors may want to do what's best for the patient. And so there can be issues within there. Within the healthcare field, financial intermediaries, financial intermediaries are out there because they can do a task cheaper than somebody else. So by doing this, it helps to reduce costs. And so if there was no insurance, everyone had to go directly to the doctor or the hospital to figure out payment and all that, then there could be a lot more time and effort spent onto that. But intermediaries in general, they can kind of look at the big picture, make decisions, and have the overall decision made there because they can see everything. Within the healthcare industry, the health insurers are those financial intermediaries. They take cash via premiums and pay it out via reimbursements. So within another thing to talk about is capital financing when it comes to hospitals. Hospitals are just like other business. They need total revenue must be greater than total cost. However, with hospitals, their operating costs need to be relatively low compared to the revenue that they're bringing in. So I've discussed at different points how the charges are greater than cost reimbursement when it comes to a patient getting charged money. And one of the reasons why is because with hospitals, they have such high costs in the front end because to build that hospital, it takes a lot of startup costs. And they need to recoup those because of it. Now, the one benefit of hospitals is that they tend to have a very, very low revenue risk. Because of Medicare and Medicaid and such high levels of private insurance, they basically have guaranteed payment by a lot of the people that come in. Now, the Medicare and Medicaid made financing of these hospitals easier because the bank said, all right, look, they have guaranteed payment, they have nothing to worry about. Great. The problem was that this kind of got taken to an extreme in the 80s. So in the 1980s, hospitals were getting built at a very, very rapid pace. Well, because of that, they tended to be overbuilt, and even though there was guaranteed payments, because people only need to go to one hospital, and it was only on a per need basis, that everything got spread so thin that there really wasn't enough demand for all that. And so there ended up being a lot of bankruptcies as a result. Hospitals, they're both for-profit and non-profit. They're both out there. The non-profits, however, they lack ownership. So while a lot of times for-profit and non-profits both make the same types of decisions when it comes to cutting costs, non-profits do not have the incentive to invest in capital gain to try to grow. So there are some issues there with that. But again, for-profits, they're possible, they're profitable, and studies have shown this. There are some differences between for-profit and non-profit as far as patient outcomes, though. For-profits tend to have longer lengths of stay, but fewer visits, while non-profits tend to be less efficient, and they don't put money into quality as much. Charity care is available. Doctors donate their time. The idea of for-profit and not-for-profit, which is better, it really depends. It depends what you're looking for. Costs versus quality can really depend on the specific area. And the problem with medical care in general and the financing part of it is that it's difficult to measure. There's a lot of risk. There's a lot of information that's not known. And, it's rich versus poor, who gets what. And so there's a lot that goes in there. But in general, capital financing, especially looking with hospitals, it's very complex and there's a lot to look into, at least relative towards other industries.